Ready to do this?
Yep.
All right. Hey, welcome everybody. Presidio Perspective. I'm Dustin TenBroeck here with Jeff Anderson in the studio, Sierra on the ones and twos. We have a good show talking about the recent earnings that have come out. We are in earnings season. What does that mean about the economy? What about all these recession fears? And what should we do with our money? So glad you're with us. Let's get it going. All right, welcome back to the Presidio Perspective. Got a lot to talk about as always. So here we are. The Q1 results of 2022 are in. We are in earnings season, finding out just how these companies have fared over the last quarter. Some bad, some really bad, some headlines we can talk about, some good. Overall, so far, and we're early into the season, but more good than bad, right?
Right, yeah. We've had some good ones this week.
Well, let's talk about the notable bad one that I think is on a lot of people's minds.
Netflix?
Yes.
Is that what we're going to talk about?
Yes, I think that streaming service that just was a rocket ship for so long, and it has definitely been a volatile stock. I mean, big moves in that stock over its lifetime. But I think it got up to 700, November of last year?
Yeah, I think so.
And it's trading at, 210? Something like that, right?
Yeah,
in the low
market
200s.
cap of over 300 billion at one point, and now closer to 100.
Less than 100.
Less than 100 now. I haven't looked at it in a couple days.
So what happened? I mean, what was the headlines, right, that caused the stock to plummet 35% in one day? You know, you had big investors like Bill Ackman bail on their share, book a $450 million loss, supposedly.
Who just bought it a month and a half ago.
Right. I mean, one of the best investors, right, out there. And, you know, you see he gets it wrong a lot. You know, that's something for us as investors to remember. Like, nobody has that crystal ball.
Right.
That's the importance of diversification and not just investing in what has been working. We did a podcast episode about a month ago about not chasing shiny objects, right? Because this is what happens. So what happened with this company?
It's just not growing as fast as it used to, not adding subscribers at a pace that analysts had expected, right?
I think they lost subscribers.
Well, not only did they lose subscribers, but what's interesting about that is a couple things. One, a lot of the growth that was kind of estimated was built off of a much higher base pandemic. You know, we had a lot of people couldn't go out. What did they do? They streamed. They ordered in.
That's what we did. Absolutely.
Right.
Tiger King, baby.
We've all watched a lot of shows, that's for sure.
That we never would have watched.
That we never, especially that one.
Yeah.
And so, they've just stopped growing. They've been raising prices, and I think there's been some pushback. And like any growth company, they've been growing. Remember, this is a company that basically disrupted the video industry.
Yeah,
took down Blockbuster.
I remember they were mailing DVDs.
Right.
That was the legendary new practice of the time.
20 years ago.
Mm-hmm.
So they've been a rocket ship for 20 years now. They've had periods of, big ups and downs. But like any company, you get to that point of maybe maturity where you're just not growing, and yet it was trading like a growth stock, and it's not growing anymore. And now the business model is in jeopardy. And now they're talking about advertising revenue as a form of boosting revenues. And so I don't think the real point of that is, I think, talking about earnings, the things that are specific to Netflix, I don't think really shed light on, or they don't really matter in terms of the economy, because we're going to get into that.
Yeah.
But the other thing, too, is just in general, having concentrated positions in stock.
Yeah, no,
is really kind of where I was trying to go with that.
Well, and then I think also it's a great lesson for investors, hopefully, that they watched and didn't experience, right? But when you look at a company and you say, wow, this is a really successful company, and I think that we'd be hard to argue that Netflix is not a successful company, and they won't continue to be a dominant, successful company, one of the best companies out there, arguably. Mm-hmm. No recommendations, obviously, on whether you should buy, hold, or sell here on the show, right? Just kind of commentary generally about, what would be a good, quote unquote, good company. But then again, something that we've talked about in the past is, there's the value of that company, and then there's the price that you pay for it. And a lot of times those can get dislocated. And you brought this up, little feather in your cap, so much last year. right? Looking at earnings, looking at like relationship to 1999, and like how can you continue to justify buying something, that does not make money, right? And has never made money, right? And you have those unicorns like Amazon that say, hey, some of them work out. But when a stock is trading at 100 times earnings or 200 times earnings and they get cut in half, if you're trading at 150 times earnings, let's say, 150 times what you make, it's going to take you 150 years with no growth to make your money back of what you paid for it. So you're assuming so much growth in the future. If that gets cut down, you're trading at 75 times earnings.
Still not a deal.
It's expensive as all heck, right? You said what the long-term average of the S&P is usually that 17 to 20 kind of range,
right?
Which is kind of where Netflix is trading now. And so, what happens is investors have to not only look about where they're investing, right, but what is that price that you're paying for these companies that you want to own. And so here's an example of when you are buying for future growth and you just get some little hiccup, and what we think that future growth is going to be, the higher the valuation, the more significant that punishment's going to be if they misstep.
Right. And you could buy, like you said, I think it's an important point you made. You can buy really good companies at bad prices, and it can turn into really bad investment returns.
Yeah, a lot of really successful investors, like the Ben Graham disciples, Warren Buffett, right? They made a lot of money buying really bad companies at good prices.
Yeah, they did.
It's like, yeah, okay, it's a bad company, but it's worth, if we liquidated the assets, it's worth more than what we pay for it, and those are kind of what value investors look for.
Right, and a lot of these high growth stocks that have been cut in half or even more, 2/3, couldn't be liquidated for more than they're still trading at. So a lot of that fluff's been taken out, but they're still trading at high multiples. But not to belabor the point about Netflix, but I think that the point was really, those are great points you made about, really expensive stocks and what can happen to it. And then two other points. One point being, we talk about building diversified portfolios. We talk about that all the time, and clearly that's the job of a wealth manager. But it goes to show you that when you have concentrated positions in stocks, how damaging it can be to your financial health and your plans. And I think that's important because Netflix is a case in point. We talked about the Cathie Wood stocks, but let's just talk a little bit about earnings in general because there's some good news out there.
Yeah, let's move to the good news. I'm getting depressed over here. Let's enlighten it up here. That was the bad one that we all kind of heard of, or whoever's been following it. If you follow the market, you've seen some headlines there.
Right.
So yeah, what about some positive things we've seen?
So what's doing well right now?
I mean, it's Counterpoint, the other big growth stock people follow, Tesla, right? Didn't they have some good earnings yesterday?
Yeah, and as a proud new owner of one,
yes,
and how long it took me to get it,
yeah.
I could have told you that earnings was going to be pretty darn good because now that I own one and had that paper plate on the back waiting for my real tag to show up, I couldn't tell you how many cars I've seen with that same paper plate that looked identical to the one I have. But the demand is so strong, and they just kept raising prices. And it just goes to show you that they're a different life cycle in their business model. And I think it was up 9 or 10% today, which is still back to $1 trillion company, and they just can't keep up with demand. And so there are a lot of the consumers doing well. So
still
yeah, Tesla had
at a really high valuation though.
At a ridiculously high valuation, and is it priced for perfection? Who knows? But it's an expensive company, but it's a disruptive company, and it's much earlier in the life cycle. Maybe Netflix circa 2004.
Who knows? I mean, who knows, right?
But
they have what Netflix has too, which is a lot of increasing competition. Right. And so I know that just our clients that are looking at getting their next electric vehicle are not, it used to only just be Tesla, and now they're looking at a lot of other automakers and manufacturers for that next big purchase.
Which is the beauty of capitalism. It's competition.
But I think when we look at these things, right, and again relating it back to the economy, so if people are out there buying cars, right, and buying these expensive cars, that still says something about our U.S. consumer,
right,
which is driving the overall market, right. What else? Other headlines did we see or positive?
The airlines.
Yeah.
I think American Airlines came out with earnings. It was the best quarter in their history.
Yeah, that's what you said. The best quarter in their history.
That's what I heard this morning.
Didn't they go bankrupt not too long ago? So their history's a little limited. But
well, I think it goes predates to the time they actually founded. But no, they had banner earnings, And if anybody has tried to book a ticket, they know that the prices are no longer those cheap government subsidied tickets that we were getting during COVID.
So both of those. I mean, when you're looking at Tesla, when you're looking at so just say any auto manufacturer or airline, I mean, that's directly related to the U.S. consumer going out and spending.
Right.
In the first quarter.
Right.
In the first quarter, right? I mean, this is. I mean, I guess you can argue that a lot of that was pulled forward. I mean, or pulled backward. When did you buy your Tesla? When did people book their airline trips?
Right.
Well, you kind of have to wonder how much of that came from the fourth quarter.
Some of it. I think with airline tickets, though, a lot of people are buying them
for the summer.
And even now, if you want to, people are paying. That's the point. Yeah. The cost of running an airline is going up with wages and the cost of gasoline, and they're charging more for baggage and all that. And we talk about consumer sentiment. We'll get into that later, but people are paying. They have the ability to pay. So
then another positive one was Nucor, right?
Right.
And so what do?
They're a steel company.
Okay.
And so again, that's a cyclical company, right? That's producing steel products that go into consumer products, and they had a record quarter and also able to pass on cost increases. So we talk about inflation. Good companies have the ability to pass on costs. The consumer has the ability at this point. They may not like it, and we'll talk about consumer sentiment later, but they may not love paying those prices, but they can and they do.
You said twice in a row we'll talk about consumer sentiment later, so why don't we just get into it?
Let's get into it, yeah.
I mean, consumer sentiment, where we're standing today, obviously has come down drastically. I mean, maybe we can get a graph up on the replay of the show, but we had a reading for April of 63.7, right? That's the headline, which is about 6 higher than it was in March. So
right.
We're better than we were in March. Part of that is, I think, because we saw actually a tick down in gasoline prices over the last month. You kind of mentioned that some of the sting of the war has kind of worn off, and you kind of adjust. There's like these jolting things that lower consumer sentiment, that fear, and then we kind of become to the new normal of something we're dealing with. But we're still 22.6 less than we were of April of 2021.
Right.
So pretty, 25% lower than we were in consumer sentiment than we were a year ago, which makes sense.
Sure.
I mean, it makes sense.
There's a lot of uncertainty out there. Costs are more. And we talked about this a little while ago, you and I, in one of our conversations, and I had brought up consumer sentiment, and I said it was looking pretty weak, and you said, yeah, but the consumer's still buying. They hate it. They hate paying that price at the pump, and they hate paying more for this and that, but they're doing it, and they have the ability to do it.
Plane tickets.
Right. But they can. And they're doing it.
Yeah.
And so,
I mean, when we look at the overall economy, we're looking at what is the state of our economy today. We still have pretty record high employment.
Yeah, we're at record employment levels, or you almost call it full employment. We're sub 4%, which is by the Fed's definition, full employment. So one of their mandates has been satisfied, and the other one is inflation, which is, as we all know, is the thing that I think a lot of clients, a lot of people are worried about, because we preach how inflation eats into purchasing power, and that's why you've got to invest for the long term to be able to keep up with inflation. And so
yeah, that's definitely the fear. I mean, when we look at the overall economy, so we have full employment. Companies are producing record earnings. We have strong corporate balance sheets still, and the consumers out there driving all of this and spending,
right,
even at higher prices with inflation. So when we look at all of this positive stuff, yet consumer sentiment is low. I mean, it's back up a little bit from where it was in March, but we're still looking at consumer sentiment in like the 2008, 9, 10 era,
right,
levels.
Yeah.
I mean, if we just put that in perspective.
Right.
So draw your conclusions where you may from there, right? It could mean, hey, we have some really bad times that we're probably in the middle of. But if you're a long-term investor, wouldn't you love to go reset the clock and, go back to the future in the DeLorean and go invest all your money in 08, 9, and 10?
Right.
I mean, the end of 08, let's say. But heck, even if it was in the beginning, you did pretty well. Right. Just holding through, and that's a very important part. But so anyway, we have all this positive stuff, yet sentiment's low, and all I hear or see when I turn on the news is all this talk about recession. So like
that is all you hear.
It is.
Right.
And it's like, oh, the recession's coming. The Fed's behind the curve. So what's your take on that?
Well, a lot of the research that I've done it's certainly not a foregone conclusion. So yeah, the news is we kind of prey on bad news. It kind of drives ratings, but a lot of the things that I've read about, and a lot of the people we've spoken to, smart people in the investment industry, are saying that the economy is actually very strong, and they don't see a recession in the near term. I mean, I've seen things pushing it out to 2023, 2024. I think it's important to mention a couple things about recessions. One, they happen. They're inevitable. Mm-hmm. And two, they're not the end of the world.
Yeah, we had one in 2020.
Right. Recessions happen. We get past them.
Yeah.
They create great opportunities. And so do we know if a recession is going to happen? No, nobody has a crystal ball. And right now, we think the probability is a lot lower than what we hear in the news media. That can change. So I think that is important to bear in mind. And again, recessions happen and they're inevitable. But I think getting back to kind of the Fed and interest rates, and we talked about full employment and inflation, it's like, how does that relate to bonds? We're going to talk about that in a minute.
Yeah. Go ahead.
And just interest rates in general. Well, remember we talked about the podcast about we were doing comparisons between the 70s and now, right? And I don't want to belabor the point too much, but whenever we're looking at things, we love to compare some other period because it's usually a playbook for what we did right, what was done wrong. And in the 70s, we were kind of behind the curve, and I think I'll just give you a 30-second update or
I got my timer going.
Okay.
So 28 seconds left.
All right. So in the 70s, we went off the gold standard, right? We were trying to finance the war, Vietnam War, and Nixon said, we can't keep giving dollars out or gold in exchange for dollars. No more of that. And we got into the expansionary monetary policy, and the Fed governor before Volcker was Burns. And he was, by all accounts, for all the academics and all the people who have looked at it, just ill-equipped to really understand the relationship that was going on at the time, which we all know about now. Even the mild investor, the common investor knows kind of the relationship between monetary policy and all these things. We've all become Fed watchers, but he was ill-equipped. Inflation he didn't think was going to continue. He let it go on for too long, and we ended up with 11, 12 years of high inflation. Volcker came in late and just said, enough is enough. We've got to change the way we do things, got to increase interest rates to get down inflation. Powell and the Federal Reserve have seen that, and he says at this point the economy is strong enough for him to start raising rates, and they're now talking about a 50 basis point increase in May, which usually is 25 basis points. And so we've talked about that before. It's getting more and more aggressive with the inflation because he figures the economy is strong enough, and if I do it now and I get aggressive now, I can get inflation, genie back in the bottle, can kind of recalibrate, and we can move on.
Yeah.
And I think that's really important. So, yeah.
So the timing is unknown. Recessions do happen, but a lot of the fears are overblown is kind of what I'm taking from this.
Yes.
Okay. You do have the Fed raising interest rates. You have record high inflation numbers. We have a war going on, right? And so there's a lot to kind of be worried about, as there always is. And then the thing with recessions is you don't know when you're in one, right? Until 9 months later.
Until you're out of it.
Yeah, until you're usually out of it, right? So it's going to be really hard for investors to do that. And there's so much talk out there about how much of this is all priced in because, like you say, the stock market is a discounting machine, and they take in all this data of what's going to happen in the future to come up with a price today. And so that's why companies will report earnings and give guidance, and you'll see massive changes in their stock price because we have new data for the algorithm to reset the price, and that's why it changes so quickly and rapidly.
Right.
Recessions are a wealth exchanging machine, and you just see more millionaires lost and more millionaires created in that same point in time. And our number one job, I think, in helping investors is to not be the losers, but to be the winners. But more importantly, to not be the losers.
Right.
Right. And so we can really get ahead of ourselves when we're trying to predict, how much of this inflation is transitory or permanent and what the Fed's going to do. I think they understand their mandate. They still, like, going back to the analogy that we used, like, they've been paying our rent, our cell phone bill, our health insurance, paying our tuitions, giving us a little spending money.
Right.
And then they slowly were like, okay, you have to get a job and do your own spending. Okay, it's time for you to pay for your own cell phone. Okay, tuition's gone. Okay, how's your job? It's good? Oh, you're making money. Okay, well, you're also going to pay for your own insurance, and I'm done. And a lot of you can relate to what I'm saying about, or maybe you're just like, yeah, those are some conversations I'm ready to have. Well, that's what Powell and the Fed is kind of doing.
Right.
Again, is saying your full employment, your companies are strong, the consumer has plenty of money, has a great job, has low debt, has a savings, and yeah, inflation starts to eat into that, but still they're saying, we're going to take care of that for you. And yeah, there's going to be maybe some short-term pain as you get out on your own, but you're going to be just fine.
Right.
And then the ending part of that whole dialogue is the important part too, is that if things get really bad, you'll always have a place to stay.
That's a great analogy. It's so true.
And when we look at interest rates, and you look at the 10-year Treasury, we call it the 10-year. It's a loan to the U.S. government for 10 years. And the rate's what now?
Close to 3%.
Close to 3%, right? And we saw that down at 1, 1.5, 2. And so now when you loan money and you're actually getting a yield on that money of 3%. So, and then when you're looking at, shorter term interest rates, they're really moving those higher. So we're seeing that yield curve invert, which is like another reason why there's some fears of recession. But part of that is mom and dad building up their arsenal.
Right.
When they cut us off, they become more financially stable.
Right.
I'm going to keep going with this analogy. It just keeps getting better because it's true, right? When our clients cut off their kids, their balance sheets grow more, their cash flows look better, right? And we do tell them that. We say, look, if you want to provide not just for your children, but for your grandchildren one day, and you will want to do that, like, you got to make sure that you're strong first, because you're never going to be done until you're finally done.
Right.
So with the Fed doing this, right, then they become stronger, their balance sheets look better, and they have more tools to their arsenal. So as interest rates are going up, if we do go into a recession, it doesn't mean everything's bad, right? They are part of the market. But if it is really bad, the Fed now has an arsenal to stimulate the economy, become more accommodative if they first get inflation under control.
Right.
And so if you really think about that, and I think that this is really priced in, who knows, right? But I mean, the Fed is hawkish. They have a mandate for employment, check. Their mandate, you say, was inflation. Remember, the mandate was to have inflation.
Right.
That was the fear. The fear 2 years ago was, how are we going to get to
2%?
2%. And then they said, oh, we'll average 2, right? So we'll
Right.
be fine letting it run a little bit. And now they're like, okay, we got to get this mandate back under control.
Right.
Because if they do have it under control, and taking the lessons from past Fed chairs, short-term pain is better, because once it's under control, now they have the full arsenal. They could be accommodative again, not hurt the U.S. consumer, right? And so they're really just following this playbook. And I mean, we really can get ahead of ourselves as investors, and I'm sure financial people and investment managers do it as well. But I'll tell you one person who's not listening to Chairman Powell's conversations, and that's Warren Buffett, right? And anybody else like him. Doesn't really care what they have to say, right?
Right.
I mean, in the big scheme of things, again, it really does not matter that much for your long-term strategy. And so it's like, so we have this recession fear. Is a recession going to happen? Yes. Do market crashes happen? Yes. Are you going to guess when those happen? No. Right? So what do? Like, what do we do with our money?
Right. Well, that's a nice little segue into bonds, fixed income, getting a lot of people concerned or questions about what's the purpose of having bonds in the portfolio.
Yeah, well, and first, I mean, I guess it would be what you said earlier in the show, is the importance of building a diversified portfolio.
Right.
It has a strategy for the long run. Like, you have a strategy that doesn't say this only works if there's no inflation and interest rates go up.
Right.
Right. You have to build a portfolio that works under lots of different circumstances. And that means being diversified and having different asset classes that are going to act differently in different environments, so that you do have something that is winning in your portfolio, even though some things might be losing for a time. You say something really powerful that I always remember, is that any investment, any really, really good investment, could look really bad for any 3-month period. And that doesn't mean it's a bad investment.
Right. And you can't make investment decisions over a 3-month period. You just can't. Yeah. Because you don't, it's these pockets where people get concerned and they want to just kind of, bonds are dead because they're not making any money they're supposed to make.
What do you want to say about bonds?
Well, first thing I thought was interesting was Q1 was the first quarter where it was one of the first times where stocks and bonds went down at the same time, right?
Yeah.
That doesn't typically happen. And then you start to hear people saying, well, bond investing is dead. Anytime I hear something like that, something is dead, that's usually a good indication that it's about to be a better investment going forward. But again, making decisions based on short-term fluctuations is just not the way to go. We don't have a crystal ball. But let's take the analogy of, let's say we do head into a recession, right? What happens when the economy starts to falter? We talked about the stock market is a discounting machine, so it'll come down, it'll sell off before recession happens. But what happens when they sell off stocks? What do they buy?
Bonds.
They buy bonds.
There's a flight to safety.
And so when you buy the bonds, the yields go down, so you make more money on your bonds.
And the price goes
up.
Well, when you buy bonds, the yield goes up.
The yield goes down. The price goes up.
Gotcha.
And so it's a flight to quality asset. Yeah. And so when you have, I'm pretty confident that Fed Powell knows what he's doing, and he's going to put the inflation genie back in the bottle. And if that tips us into a recession, who knows? But at that point, if that happens, especially it becomes even more, if all of a sudden the 10-year is at 3.5%, a lot of people are going to love to own that in a recession versus bonds at 1%.
Right.
So to say that bonds are not going to provide a ballast in the portfolio long term, I think would be premature. I think just because it's acting strangely in this quarter doesn't mean that necessarily that's the way it's going to be in the future.
Yeah, I mean, going back a couple of years ago, I remember our big fear, even going back to the end of 2019, and end of 2020, and you're like, okay, looking at where the 10-year was, there was no room. Like, you're really wondering how that ballast was going to be created. And so, we've seen some short-term pain in fixed income, but again, it's build that ballast in your portfolio.
Right.
There's that future demand. So if we do go into recession, stock market sells off, there's where your safety is. Right. That's a good point. Because it's investors a lot of times tend to look at what's not working in their portfolio and say, I want to be out of that. Usually at the worst time. Right. And so that's
it's the same as chasing those shiny new objects.
Yeah. Right. And so fixed income could kind of be in that camp. I see a lot of people could feel that way. And I know there's, we'll could have a whole other podcast on different types of fixed income investments and treasury inflation protected securities that, are pegged to inflation and having different maturities with different durations. And we get a little heady, but, when you build a portfolio of fixed income investments or bonds, you're not all your eggs in one basket, right? It's going to accommodate a lot of different kind of market cycles. But
we should mention just one other quick thing, if you don't mind. When you have a bond fund or you own a bond and it matures and rates are going up, you get to reinvest at higher rates.
Yeah.
So that's important.
Yeah, absolutely. That's that laddering strategy. So, and then what about the growth companies, right? And so you've seen, and we've talked about this a lot recently, these companies that are off their all-time highs. Why do we stay investing in growth?
Right. Well, there's two types of growth companies, really. I hate to use that term duration, but it's the only way I know how to explain it.
Sure.
I know. But long duration growth companies, what is that? What does that mean? That
Paying
just
up
means
for more money in the future,
that,
right?
Yeah,
further out in the
that
future.
Means that these companies are growing sales like crazy. They're investing in their business. They're not making any money.
I don't care. I'm buying the company for what it's going to be 10, 15 years from now.
Right. But if that earnings stream is out 10 years from now and interest rates go up, that discounting machine formula discounts it at a higher rate, and it makes that company less valuable today. And those companies that have those long duration assets or earnings power, and the risk that they don't actually earn it, because you're putting faith in a company that's saying we're going to grow this way and in 10 years we're going to be earning money. Well, you're putting your faith in them.
Or just the sector in general, right?
Right.
I mean, if you're investing in index funds or mutual funds that buy these types of companies, right, you can have a bunch of them. You're not betting on any one company, right?
Right. But if you look at some of the other growth companies that have been around for a while and are still growing, like what's a growth company? Well, it's growing at a higher rate than the economy. And so, but they have earnings. And so they have earnings now, not way out in the future. Yes, in the future it's going to be a lot higher, but they're earning now. They have held up much better. Cash flowing companies today that are growing faster than the economy will hold up and have held up better than those speculative growth companies that may or may not produce earnings way out in the future.
And this always comes back to why it's so important that investors have a strategy that has time horizons tied to their investments.
Right.
Over longer periods of time, those growth companies, especially the ones that don't cash flow, have made a tremendous amount of money over the long run. However, they are riskier, meaning that they are more sensitive to the economy, recessions, interest rates, inflation, right? You miss a little sales number and you're going to see big drops, or you just barely beat, you'll see a big up. So there's a lot of volatility.
Right.
And I think investors, understand somewhere intuitively there's a trade-off between risk and reward.
Right.
And over the last 5 years especially, we've seen risk tolerances that we do assessments with clients, and they've been increasingly aggressive. What happens when there's a change? Because when everything's going up, right, people are like, yeah, I want to be aggressive because being aggressive means I make more money. It also means that at periods of time, your portfolio is going to be down worse. Like you're not going to be doing as well as more stable companies that cash flow, that might not make the most over the next 10 or 15 years, but you're going to be subject to these greater, gyrations.
Yeah.
And small cap or large, or those high growth companies, right? So investors are getting that lesson today, and hopefully they've chosen investments that they were comfortable holding in that time period. Of course, if you're with Presidio, that has been mathematically calculated before your portfolio is allocated. So,
right.
You can sleep at night there. But I mean, that's just so important that people have a strategy to begin with, and so that they understand that there's going to be periods of time, 3 months, 6 months, a year, 2 years, 3 years, whatever it is. And we've seen that happen before. But, we were in this business in 2008. I saw paper money evaporate. Right. And so it's a good time for investors to make sure that they know what they own, that they are in a proper asset allocation. Okay. If you're thinking about doing any big moves with your portfolio or real estate or whatnot, like it's time to get the plan and get your long-term holding periods, because if we do go over, like you're holding. But if I go back to that time, and you and I have talked about this so much, right, during those recessionary times, if you could have just stepped back and not focused on what the Fed was going to do, what the inflation reading was, what the consumer sentiment was, and you were able just to ask yourself, are people going to stream more in the future? Is social media going to continue to be a powerful force? I mean, I'm talking about the kind of the 2008 days, right? Are people going to use Google and watch YouTube? And is that going to be a trend where people use more internet? Is the Internet of Things going to continue to evolve? Are people going to stop going to big box retailers and shop online? And all the data was there to suggest that was the future. And if you could have ignored all that other noise that was going on with the financial crisis, you would have had a volatile portfolio that made a ton of money. Right. And so it's still important, that investors, I think, keep that in mind, right? And this is why a lot of wealth is created in recessions and a lot of wealth is lost, because of people making these short-term decisions and then those that make the long-term decisions. So there's some great buying opportunities in those times too. But that's why you have some fixed income in your portfolio. You got to have that ballast. Right. You can't buy more if all of your money's in that thing. And so hence why you have a diversified portfolio that does rebalancing. What does rebalancing do? I have these, lack of a better, analogy, two assets. One went up, one went down. I have to sell the one that went up, buy the one that went down to bring my portfolio back in line. Well, that's selling high and buying low, and I'm pretty sure that's how you make money. Right. Right. So that's that important. So Always a lot to talk about, Jeff. Always a pleasure to get through it all with you. I like that we keep coming back to the same place because that's really how wealth management is supposed to be, right? All of this noise, we give you our perspective on it. There's always that wall of worry that we're climbing. We'll always stay in tune, make sure that our clients and our listeners stay informed. But we'll be back a couple weeks from now with a lot more to talk about, I'm sure.
For sure. All right. Thanks.
All right, man. Good having you. Thanks, everybody, for joining us. We'll see you next time at the Presidio Perspective.